Great. Morning, everybody. Thanks ever so much for taking the time to log into this webinar. If, like me, you've been sitting in front of team meetings and Zoom meetings and webinars, you're probably a bit teamed and zoomed out. So I'm going to keep this pretty swift. I've been on some presentations which have gone on for quite a long time, and you're gagging for a cup of tea at the end. My contact details are at the end of this. I think I know most of you on the call anyway, but if anybody wants to pick up on a specific point post meeting, then I'm more than happy to discuss any specifics. In order to consider the title of my talk, COVID pounds, and I don't know about you, but I've got a couple of COVID pounds I'd quite like to get rid of, but what impact could COVID trading have on values? I think it's first very important to visit how we approach the valuation of petrol filling stations. I'm sure most of you will be familiar with the fact that it's a profits method of valuation, which is generally adopted for operational real estate, and we have to have regard for the trading potential of the business, and we analyze that by looking at profitability or otherwise, through viewing past trading performance, current, and what may happen going forward. But are we looking at a fair and maintainable position which is currently being sort of thrown into uncertainty, or actual trade? And I think in order to answer that question, we also have to consider whether what is the valuation being done for. We can get into trouble as surveyors by using the phrase valuation if we're not too careful, because we have to be careful we're not providing formal valuation advice in the context of what we do, which could be taken away and relied upon, and then we could get sued for it. So the question is my valuation because somebody else needs to rely on it, such as a bank for secured lending purposes? It could be for company accounting purposes. It could be for matrimonial, probate, and many other reasons. But if it's a document somebody else needs to rely on and needs a formal opinion of value, then we have to undertake a valuation in accordance with the RICS Valuation Global Standards document, which is more familiarly known as the Red Book. And that goes into enormous detail on each and every asset, and we end up producing a very thick document or a very long PDF, which takes a lot of time and effort. Or alternatively, I need evaluations. I'm thinking about putting my site on the market, or I'm considering doing something, or I want to let it, whatever it may be. And in that case, we are able to provide marketing advice and indicative pricing advice and a guide price and so on and so forth in the course of a estate agency. And whilst in theory the results should be more or less the same, they're often not. And it's a conversation I've had with a lot of people over the years. And why is that? Well, if we take a look at the definition of market value from the Red Book, it is the estimated amount for which an asset or liability should exchange on the valuation date between a willing buyer, a willing seller, in an arm's length transaction after proper marketing, and where the parties had each acted knowledgeably, prudently, and without compulsion. And if we sort of just look at that phraseology, there's probably a few things in there you think to yourself, well, actually, if I've bought or sold a site in the past, do all of those things apply? And quite often that's not the case, and that is the root cause of sometimes why there is a difference of opinion that a valuer might have versus what actually has been done in the market. And I'll get to the point as to why I'm talking about this in the context of COVID in a minute. But if we look at the assumptions that comes out of that definition, at its simplest level, that a valuer has to work on, first and foremost, we have to acknowledge that the valuer could be valuing an asset that is part of a transaction for secured lending purposes, for example, and may have knowledge or not of what the strike price has been. This is an estimate of the expert of the value based on that valuer's opinion. It's not necessarily the actual price that's been agreed. And that may flow from the rest of the assumptions that we're working on here. So is the buyer a willing buyer? I know that sounds a bit odd, and in most instances, of course, a buyer is willing, but for example, there may be a package deal that's being done with a couple of dog sites in there that the buyer doesn't really want, but actually it's part and parcel of the package that you have to take those ones as well. So we have to be really careful if we're analysing those transactions, because in that instance, the buyer may not have been willing for those particular assets. Then we look at the willing seller. Now, again, most sellers are generally willing, although actually, if I approach somebody and say, I've got a client here that wants to buy your site, you might not be a willing seller. And actually, we might agree a price that's over and above what could be the market value, because you're not really a willing seller. And alternatively, if there's a forced sale situation, then, clearly you're not a willing seller in that instance either. So we do have to have regard for the fact that both parties are acting on a willing basis. We have to assume as well that the transaction is at arm's length, which means that it can't be between connected parties, which could be family members, it could be intercompany transactions, those kind of things, which could be seen as friendly deals. And there's also assumption that proper marketing has taken place. And actually in the petrol filling station market, it's quite normal for proper marketing not to have taken place. So, how do we treat off-market deals as evidence, and how do we bring that to bear on a valuation that's being undertaken by the valuer? The valuer assumes that the buyer has acted knowledgeably. In other words, for example, we assume that the buyer has undertaken full due diligence on the purchase. So we expect them to know of all of the ups and downs and the pitfalls and the pluses and the minuses. And we assume that the buyer has acted prudently and without compulsion, which is an interesting one to try and get your head around. But that's, for example, where next door neighbour is there to buy the site, and they're a special buyer because there's a special interest in buying that next door site. That could apply if you trade in an area and you own all the sites in that area and one comes up, but you might be prepared to pay more than the market value for that site because you want to control the sites in that area. So there's a whole range of things that a valuer has to weave into their valuation to arrive at their opinion, disregarding a number of things and having particular regard to certain things. And then you throw COVID into the mix, and for a period of time we've been working with what the Royal Institution of Chartered Surveyors calls material uncertainty, where there is a paucity of market evidence, and therefore the valuation should be relied upon with absolute caution. And there's a lot of wording that goes into the report there to caution the reader to have regard for that particular fact. So the basis of valuation it is an opinion based on all of those different things, and when you put them into the melting pot, can differ from what a strike price might well have been. To bring it sort of back to reality, I suppose, just to illustrate the point a little bit more, the valuer will review, as I said before, past, present, potential trading against industry performance indicators when arriving at their opinion of fair and maintainable trade, which is another part of the definition that the valuer is working within. So this is a graph of oil prices at the moment, and as you can see, that goes back to November 2019 and up to yesterday, and the price has fluctuated enormously over that period, and you can see where the dip has sort of gone quite a long way south in the middle there. Where is the trend? What is the fair and maintainable level of oil pricing? You'd have to kind of draw a very slightly declining straight line, I think, left to right on that, and your ongoing view is going to be somewhere around the middle right hand side of that graph, I would suggest. And that's the same kind of view that a valuer has to take, because there is a direct impact here clearly on the likely pence per litre margin that you can achieve from a site based on what oil prices are. So we've all tracked the loss of fuel volume through COVID. People were talking about being 80% down in instances. I mean, there's been winners and losers across the board, but it seems to be that we're back to kind of 82% ish on average of what normal was from a year ago. So the valuer has to make a judgment going forward as to where that level will settle. And if we kind of then think on as well about the shop sales, we know that forecourt shop sales, along with the rest of the convenience market, have generally been rising across the UK as a result of introducing alternative products. Generally, we've seen margins have been improving as well over the last few years, with more coffee for sale, food to go, fast-moving convenience goods that have high margin levels. But the question for the value is, what is the sustainable level of shop sales after COVID? We had the whole panic buying scenario at the very outset, which meant that people were shopping in convenience stores and forecourts with convenience stores instead of going to the large supermarkets for a number of reasons, not least the fact that you could probably buy some toilet roll and flour in a petrol station because not that many people were going there to start with. But once that subsided, we've actually, I think this information was from ACS, the convenience store basket size has increased on average by about 17%. In some instances, sales were up by 40%. And what is the sustainable level going forward? There's commentary at the moment that more people are doing more top-up shopping in a planned way to mesh with online sales. Independents have generally had probably better availability than some of the multiples in some instances. I mean, there are some exceptions, obviously, with town centres and transport hubs where it's not such a rosy picture. But the ongoing sentiment moving forward appears to be that there could be, on average, and averages obviously hide lots of highs and lows, a 10% increase in sales, which could be sustainable going forward. And that's because people that never used a local shop before, that always went to the supermarket, for example, suddenly realised that their local shop is actually giving them a very good service. They can actually get products in there they didn't realise they could get in there. And actually, the pricing's not ridiculously different to the supermarket. So actually, why should I trek to the supermarket to go and get these bits and pieces when I can buy them locally? So I think there's going to be a bit of a bounce moving forward generally. But the bottom line here is, what is the sustainable level? And you can apply this kind of conversation across all levels of income on a forecourt site. So you may have lettings to an MOT vehicle repair sales operator, and they might have seen a downturn in trade, and you may have agreed a lower rent with them for a period of time. But what's that going to come back to? The valuer has got to take all these aspects into account when they're sort of looking at the value. So moving on to look at a practical example, just to keep it very, very, very simple. The table here shows the numbers that we typically see produced by a reasonable independent petrol filling station pre-COVID and before lockdown happened. So this particular site was doing 2 million litres of fuel. They're achieving around 7.5 pence a litre, or that's what we've adopted as the sustainable level of profit on the fuel. They're doing 14,500 a week in shop sales, and we're assuming that that's been achieving 25% margin. There's some other income there of 20 grand. That could be car wash, it could be rental income, it could be anything. The overall site contribution there before expenses is £358,000. And when we take off the wages and other costs of running that site, the bottom line's coming out on an adjusted basis of 196,625. Just to keep numbers simple, we'll put a 10YP on that. It's getting us to a value of 1.97 million quid, which is 5.5 times gross profit, which is, at the steamy end of things, but look, it's an example. Now, if we then think about what the valuer might be having regard for looking at the market, looking at the commentary that's happening out there and some of the things we've just looked at, we could then make some adjustments. So let's just say that the sustainable position of the fuel is it's down 18%. Let's just say that actually margins, because of the lower oil prices, are up a couple of pence on a sustainable basis. That's immediately giving us an uptick in the income from fuel. And then the shop sales, we've just said, if we make the assumption that the sustainable level of shop sales is going to increase by 10%, that gives us extra income there as well. The net result is that the gross profit goes up from 358,000 to 382,000. there's a bit more expenses there because a busier shop means there's probably higher running costs, but the bottom line is up to 210,000, and if we apply our same 10YP multiplier, that's getting us 130 grand's worth of extra value just on the face of it. So, that's the possible scenario that we could see as a result of COVID. Now, of course, there will be sites where numbers have gone down, and so therefore the adjustments can be made in a commensurate way. But the big sort of question, I'm pleased to say that when we're valuing sites, the valuers are always talking to our brokers about what's happening in the market, because it's all very well looking at these numbers on a spreadsheet and in the cold light of day, but actually when you take a step back and see what's happening in the marketplace, that is where you put some color around the numbers and say, well, actually, would somebody pay that? Who's in the market to buy that site? Would they buy it now? Are there more buyers around at the moment, less buyers around at the moment? Can you borrow from the bank to purchase at the moment? And the bottom line is that actually, yes, that is happening. That is happening right now. So COVID came along for us, and we all got locked down on the 23rd of March. Everybody worked from home. We furloughed a whole load of staff to start with. I think, like a lot of people did. But there was a very strange situation. We had a massive increase in the number of buyers registering to buy a retail business through Christie and Co. Admittedly, a lot of that was in the standalone convenience market, but actually that included petrol filling station buyers as well. And I think there was a flight to a business which is likely to be robust through difficult economic times, because everybody uses a petrol station, everybody uses a convenience store, even in hard times. And we saw that in the last recession. So we saw quite an increase in the number of people looking to buy. We had already got 23 deals either completed or in legals at that point, and we tracked all of those very carefully. And frankly, there were some deals that just paused for a few months. The buyers were basically assessing their cash flow. We're not wanting to make a legally committed move until they knew how we were going to start to trade out. And I was, like everybody else, looking at the helpful numbers that the PRA was sending around in terms of the fuel volumes. And actually, that's one of the statistics we've used in our buyer sentiment survey now, the fuel volumes that were being sold, because the graph just started to rise once the government started to release the lockdown. And none of those deals fell over. In fact, we've agreed more deals since then, and there's 26 in the pipeline right now, which are probably going to complete before the end of Christmas. Project Ranger, which we launched, unfortunately, in February with a bid deadline in April, we had to put on hold. We then relaunched it when the lockdown started to lift and people started to move around again. And I'm delighted to say that there's a deal agreed on that now. And actually, YPs are fairly normal. I think there's a little less froth in the market at the moment, but there are certainly deals happening. And from that perspective, the market remains robust. And I don't think we have to rely on the uncertainty clause that the RSS has issued, because there is evidence of transactions that are happening out there. So, like anything, each site is individual. Each set of information, a valuer, whether they're to provide agency valuation, needs to be regarded in isolation. But you need to have comparable evidence to compare what you're valuing and with what's going on in the marketplace. And at the minute, the market remains robust and is kind of back to where it was very, very early part of this year. So I hope that provided you with some insight into how we see things at the moment in this difficult time and what impact COVID trading might have on values. But also, hopefully, it goes some way to understand what some formal valuation and the reality of a deal that might have been done. And if you've got any questions, I'm happy to answer them on the chat now, or alternatively, there's my contact details if you want to contact me.
Thank you, Steve. That was excellent. Appreciate that. We have been online now for the best part of an hour, so can I suggest we have a 2-minute comfort break? I know I need one. We'll be back on with the next 2 presentations.